Okay, well, I have 10:02, so we're going to go ahead and get started. Good morning and welcome to the Understanding Financial Statements webinar. My name is Daisha Clark and I am the Assistant Director of the PSU SBDC. And today we are going to go over some couple different financial statements that will hopefully, when you understand them, you'll hopefully be able to use them in making your business more profitable. Before we get started too far in, I did want to mention that you are welcome to use the Q&A and the chat box. I will take time at the end to answer questions. I also, if you had registered, you might look in email. I did send out 3 slides that we're going to go over this morning. It might be helpful if you can print those slides out real quick. When I do this presentation online or in person, I print these slides out for my participants because I have them set some slides next to each other. So if you want to take a couple minutes to see if you can print those slides out, that might be helpful while we're going through this presentation. So again, good morning. I have a couple goals for our webinar this morning. The first one is that I always say is that to be interactive. Unfortunately, with Zoom, it makes it a little more hard. But if you, I normally allow, or I encourage actually my participants to ask questions while I'm giving the presentation, just because I think that works better and you don't forget your questions and we can just kind of talk about it in the moment. But since we're in a webinar, use the chat and Q&A and I can go back to slides later if we need to. The next goal is that I hope that you just come away with a nugget or 2 of pieces of information that will be valuable to you in running your small business. So where are we going? This is just a little roadmap of the things that we're going to discuss today. What are financial statements? Why do we need them? And how are they created? So we'll touch on those. So to start with, what is a financial statement? A financial statement is basically just a collection of reports about a business's financial health. And we're going to go through several financial statements here in the next hour or so. And I want to tell you right off the bat before we get looking at these that I'm using 2 different businesses. One's called Adams Lawn Care and the other one is called Eve's Big Lawn Cafe. And these are just fictitious businesses that we've made up for the purposes of this webinar. And I also want you to know that they're just representative of what you might see in some of these statements. They're definitely not exhaustive or comprehensive list. So your balance sheet or your financial statements could look a little different or maybe a little longer than the ones that I'm going to show you here. I kept these pretty short just so you could hopefully understand them a little bit better. If you do have questions about your business's financial statements, we can definitely schedule a meeting to sit down one-on-one and go through your reports if that's something that you're interested in. So we're going to talk about 3 primary financial statements today. And normally I ask my crowd of participants if they can give me what those are, but since this is not interactive, I will just show you here on my screen. The first one that we're going to talk about is a balance sheet. The second one is a profit and loss or income statement. Sometimes in the financial world, they use two different names for the same thing. As there's another, on down the presentation, there's a couple other times that this happens. So just know right off the bat here that profit and loss statement and income statement, those can be used interchangeably. Those are the same thing. And then the last one that we're going to talk about is a cash flow statement. And that one is probably the one that's least talked about, or that you least hear about, but that's the one that we use here in the Small Business Development Center the most when we're trying to help a business get started. And we're trying to see what kind of cash and they will be able to have. The bank requires a 3-year cash flow statement when you go get a loan. So we work with the cash flow probably more than the other two as far as what I do in my job. But all three of these statements together will help you see the bigger picture of your business. So balance sheet. Why do I have the A and the L underlined under balance sheet? The A stands for assets and the L stands for liabilities. So you can know from now on out that only assets and liabilities show up on your balance sheet. So that's a good way to remember the two differences between a balance sheet and a profit and loss statement. Balance sheet shows assets and liabilities, and with the AL, that just helps me remember that I know what the balance sheet shows. That's just a good reminder for me, and I think it'll help you as well. So a balance sheet, I have a picture of a bank here. A balance sheet is like a personal financial statement. So it tells us what you have versus what you owe. Think of it like a savings account, like how much money you have in the bank. So a personal financial statement shows that you may have a house and a vehicle and a credit card and a bank account. And then on the liabilities side, then it'll show what you owe on those items. And at the end is what your net worth is. So just like your personal financial statement sheet, your business also has a balance sheet. So that's going to be the first one that we look at. If you have printed them off, go ahead and lay that balance sheet out in front of you while I'm talking about it here on the screen. And that way you can kind of make notes on it. So assets. Assets are just what you own. So like I said, cash that you have in the bank, accounts receivable. These are sales of product that have been invoiced but not paid, but you know that they're going to get paid, obviously, or we hope that they're going to get paid. In this example with Adam's lawn care business, he has a lawnmower and some tools, and he has a company truck. And so adding all those things up, then we have what our total assets are. On the flip side of that is called liabilities, and that is what you owe. So accounts payable is any bills that you have to any suppliers or vendors that are outstanding. So any rent that you would owe, or electric or water, any bill that has come to you that you have not paid yet is an accounts payable. And then a note payable. Adam has taken out a loan on his truck. His truck cost $16,500, and he took out or has $15,000 on a loan that he still has to pay back. So adding those two things up is your total liabilities. So if you take your assets minus your liabilities, then you have what we call owner's equity or net worth. So here again, we have two terms that mean the exact same thing there, and they are interchangeable: owner's equity and net worth. Sometimes you'll hear accountants and bankers call them owner's equity, and then more of the lay population would maybe call it net worth. So let's go through what net worth is. The first one listed here is capital stock. Again, capital stock is just owner's investment. So any money that you have put into your business. And then on the flip side of that is owner's draw. So any money that you have taken out of your business. So if you're paying yourself $1,000 a month for your salary, in an LLC, that is considered an owner's draw. You as the owner are not an employee. You don't have taxes taken out of your paycheck. So we just call that an owner's draw instead of that showing up on the expense side where your wages would show up. And then retained earnings they are profits that are generated by the company that haven't been distributed to the owners. So this money can be kept to be reinvested into the business, or it can be kept as a reserve to pay off a debt or to purchase a piece of machinery or some other asset. So you can see that your total assets equals your total liabilities and equity. Sorry, it looks like I have and in there twice. So when you add total, when you add your total liabilities, which is $15,150, and your total equity, $20,735, that gets you to the $35,525, which matches up to your total assets. Okay, so that's balance sheet. Assets and liabilities equals owner's equity. Doesn't seem, it's just adding and subtracting here. Okay, the next sheet or statement that we're going to talk about is a profit and loss. And again, it's also called an income statement. And the reason I have a picture of an IRS stamp here is because this is what the IRS cares about. This is the report that they pay or that they use to know how much taxes you're going to have to pay. So it summarizes the revenues and expenses of a company over a period of time, either monthly, quarterly, annually. So this statement shows income and expenses, or income and expenses is probably the best way to say. And again, this is the profit and loss is what the IRS looks at in order to figure out how much that you will owe in taxes. Okay, so if you have printed off the slides, go ahead and pull out the profit and loss sheet and kind of put it in front of you. And we're going to run through here. And again, this is just a representative sample of what you might see on a profit and loss. This report will tell us how profitable your company is, hence the profit and loss. So when you pay taxes, let's start at the top with sales. So sales, this is any product or any services that you have done. This is your sales. This is what you have collected. Then the next thing is cost of goods sold. So cost of goods sold in Adam's business would be like oil and gas. Maybe in a food business, your cost of goods sold is going to be your ingredients. If you have a boutique, then your inventory is going to be, you know, whatever you have in your store that you purchase to sell. So those are all cost of goods sold. So we put the sales and we subtract the cost of goods sold to get your gross profit. Okay, and then everything else pretty much is expenses. If it's not a cost of goods sold, then it's some type of an expense. And you can see profit and loss sheets that are super long and are super detailed. It's just kind of depends on how much detail you want to look at the end of the year or whenever you want to pull this report. So you can see at the top that it says January 1 through December 31 of 2018. A profit and loss statement is showing a series of time, whereas the balance sheet, which I didn't say this earlier, I should have, a balance sheet is just a snapshot in time, and a profit and loss is over a period of time. So a balance sheet is just on, you know, this day, whatever day you pull it, that's what your balance sheet looks like. And it can change, obviously, from day to day, depending on accounts payable and all kinds of different things. So this profit and loss is over a period of time. So you have repairs and maintenance, advertising, taxes and licenses, utilities, insurance, all kinds of expenses. I'm sure there's many more here that I haven't listed that you can think that you have in your business. Some people lump utilities all together. Some people would have TV or Wi-Fi, maybe office supplies, stuff like that. So when you add up all those expenses, obviously you get your total expenses. But when you pay taxes, you don't have to pay taxes on all of your income. What the tax man lets you do is he lets you take out your expenses. So he lets you subtract off your expenses. So then all you end up paying is your net income. So sales of $20,000 and you have cost of goods of $3,000 gets you a gross profit of $17,000. So just because you had sales of $20,000 and you have gross profit of $17,000, you don't pay taxes on either one of those numbers. You are allowed to take off all your expenses. So then the only thing that you would pay taxes on is that $10,090. So you guys all thought that the tax guy was not very friendly, but he lets you take all those expenses off. Okay, so let's talk a little bit about the loan payment, where it says interest only here. I want to point that out. The IRS does not let you take off your entire loan payment. They only let you take off the interest. So Adam has a truck, so it doesn't matter what he's paid the bank for the principal amount of the loan. You can only take off what the interest is. The next thing I want to talk about is the depreciation. So back on the balance sheet, I said that Adam had purchased a truck for $16,500. So the IRS lets you divide a vehicle asset over 7 years. So if you took $16,500 divided by 7, that's approximately $2,360 that you see there on my screen here. So for every year for 7 years, the IRS is going to let you take that much off on your profit and loss, so you would pay less taxes. So it depends on, the IRS actually has, you can go out on their website. They have, it's called a depreciation schedule. So different, like I said, a vehicle is 7 years, different items that you purchase have different depreciation years. So, and your CPA or tax person will be able to help you figure out what your depreciation is on the assets that you have. Okay, so income, again, we're just doing simple subtraction here. Income minus expenses equals net income. So just like on the balance sheet, we're just doing simple subtraction here. And so that's the balance sheet. We will come back to this, or I'm sorry, that's the profit and loss sheet. We will come back to the profit and loss sheet here in just a second after we talk about the cash flow statement. So the cash flow statement is kind of like how much money you have in your wallet. So if you printed out the cash flow statement, go ahead, and what I want you to do is take that profit and loss that we have and put it to the side. So you have your profit and loss showing and your on the left-hand side and your cash flow statement on the right-hand side, because we're going to talk about these two kind of in conjunction, and it's going to be easier if you have your profit and loss next to you. Okay, so the cash flow statement, and again, this is for a period. This happens to be for the month ended December 31, 2018. When we do cash flows for businesses, we do them for running 3 years, so 36 months. We do a cash flow, but I'm just showing you basically for the end of December here for Adam's lawn care business. So I want you to kind of understand here how the profit and loss and the balance sheet and the cash flow kind of all work together. So as you can see here on my screen, the two numbers above the green line come from the profit and loss. So if you have your profit and loss, you can look over and see that $20,000 is your sales. So that's just a direct pull across. The next number is a little tricky. So what we have to do is, if you look at your profit and loss, we have to take that $3,000 cost of goods sold, and for this purpose, we have to add it into the expenses. So if we add the $3,000 cost of goods sold to the $6,910 from our profit and loss, which was our total expenses, that gets us $9,910 total cost of expenses. But for the cash flow, we cannot use the interest only loan payment or depreciation, because those are not actual expenses in this case. So like I said, this is a little confusing, and it's easier to teach this concept when I'm face-to-face, because I know my participants have their sheets pulled out and we can really kind of drill down and talk about this. But your loan payment interest only for $1,500 and your depreciation for $2,360, and I'm taking this again off the profit and loss, is $3,860. If we subtract $3,860 from the $9,910, we get the $6,050. So if you have questions about that, I can do a Zoom with you and we can talk more. That's a little confusing on how we come up with that $6,050 number. But hopefully I explained it so you can understand it. Okay, so the numbers, so now I want you to take your balance sheet and put it beside the cash flow statement, because the next four numbers are a direct pull from the balance sheet. So the purchase of the lawnmower is a straight pull, $2,500, and the purchase of tools, the $150, and the purchase of his truck, which he has that $1,500 or $15,000 loan, and then any investment by the owner, which also is a direct pull from the balance sheet. And the last two numbers are numbers that you can probably get from the bank. If you don't know them, you probably have your loan paper, so you would be able to know if you had any bank loans for the period. Adam purchased his truck for $16,500. That was his loan. And then obviously he only has $15,000 left to pay on it. And the total amount that he paid off was $3,000, $1,500 of that being interest. But here we show the whole $3,000. So then this tells us that at the end of December, this is what he has left over. So he started with $20,000, and then he has all these different expenses, and this is the final number. Obviously that $8,000 is an increase there, but everything else here would be an expense. So that's the cash flow. And again, what we try to do on a cash flow is, say you're working in retail or a restaurant, either one, we try to list out all of your items that you're selling, what the cost is, and then what you're going to sell them for, so we can see what your margin is. And then we look at what days of the week you're open, how many hours you're open, and we try to see how many people are going to come in your business. We ramp you. Obviously, on day one, your expenses are fully loaded when you start, but your revenue or your sales are going to not be fully loaded on day one, and it might take you a year, year and a half to get all the way up to your capacity or where we think you can make money. So this cash flow really helps us determine like how much working capital you're going to need, what your total loan amount needs to be. So the cash flow statement is very beneficial for a startup company, but also if you're looking into the future to expand on a product line, or you're thinking about adding another employee and you want to know what that looks like. So a lot of different reasons that your cash flow is important to look at. So the next slide just shows all three of these statements side by side. And again, I just want to reiterate that in order to get a complete picture of your business, it's better if you can look at all three of these statements side by side. Okay, now we're going to transition into why do we need these financial statements and how can they help us? What do these statements tell us? So I've talked a lot about using the profit and loss, obviously, to pay taxes, and using the cash flow to help you get a loan, but that's not the only thing that they're used for. So the next four things here, I'm going to go through understanding startup or seasonal cash and inventory needs. They help us, they can be an early warning indicator for us if we look at our cash flow and we see that our actuals are different from what we projected, that can kind of they can tell us a lot of things, but that can help us right off the bat say, ooh, you're running over, you're not hitting your sales like we thought you were. What do we need to fix? Industry benchmark comparisons. We have access to reports in the SBDC, and that can help you look at those, and fraud and embezzlement protection, which nobody likes to talk about. But if you as an owner are looking at these reports, it will help you hopefully avoid that. So the first one is how to plan for startup, cash, and our inventory needs. So we're switching over and I'm using Eve's Big Lawn Cafe. And the black line here is revenue, the red line is expenses, and then the green line is working capital. So I mentioned this a little bit ago about how using a cash flow could help us understand how much working capital that you would need when you start off, or for the 3 years that you're getting started. So you can see that at the very start in January, that Eve's Lawn Cafe, her expenses are running a little bit higher, clear until about somewhere in August, and then her revenue starts to be higher than her expenses. So we know that when Eve starts out, that she's not going to be profitable until sometime in August. Are her revenues even going to be over her expenses, which is typical for a startup restaurant, and the banks understand this. And so that's why we look at this and we say, okay, she's going to be by August, maybe about $11,000 in the red. And so we need to make sure that we build that $11,000 of working capital into her loan so she can be prepared, because she's not going to have the cash flow to be able to pay her bills until about month 8 or 9. So in order to start Eve off on the right foot, and that she doesn't start in 6 months and then close down, this is the kind of thing that we help companies do, so you don't see a restaurant go out of business in 6 months. So usually if a restaurant goes out of business in 6 months, this is why. So out to the side in the box here, it says if you don't plan for the max cash crunch, you could be posting an ad for restaurant equipment sale for only 6 months old, which if you're in the restaurant business, you've seen this, I'm sure, and you know that you can go on Craigslist and eBay and buy fairly new restaurant equipment for 50 cents on the dollar because of this situation right here. So the next reason it's good to look at these reports is in case you have a seasonal business, it helps you understand what your inventory needs are going to be. So seasonal businesses sometimes forget to plan for off-season bills. So same thing here with the black line being revenue and the red line being expenses, and the green line being working capital. And this, we flipped back to using Adam's lawn care business, but you can see in January, February, and March that his revenue is running lower in those 3 months, and then on the outer months of November and December, which we totally expect because he mows lawns. So his mowing season is somewhere in between March and April. So we need to understand that so we can make sure that he has enough working capital on the front couple of months and on the back couple of months to carry him through his off season. So that's just another another reason we want to do a cash flow for your business. Okay, so the next one is early warning indicator. If your actuals don't end up meeting your projections. So your projections are what we do and what we help you with. That's your cash flow. So what happens if you're missing your projection? Okay, so if you look at the bars, the black and the gray bars, those are revenues, and then the two lines are the expenses. So we're going to look at the bar lines first on the revenue side, and we can tell that in February he was running a little bit ahead of what we projected, and he was doing pretty good until about May. And then in June, July, August, September, October, November, we see that we projected a little higher than what Adam's lawn care business was able to do. So that just shows us in a quick glance here that something's going on possibly. So we need to figure out what the root issue is, and sometimes it can be explained, or does it need to be fixed, and do we need to do updated projections to reflect that? So examples here in the box here, does he have too many employees? Is he paying too much in wages? And that's why his revenues aren't hitting. Does he need to buy more or less supplies? Did he need to borrow more money or less money even? On the expense side, the yellow and green lines, you can see that his actuals, pretty good. They're running really close. And then his actuals here in July, August, September actually ran under what we had provided or what we had projected. So that's actually a really good thing. If they would have ran higher and he would have said, hey, my expenses are higher because gas was more expensive, then that's something that can be explained away. But if you're not sure why his expenses are running higher, then we may need to dig into and look more at his profit and loss to see if we can figure out what he's spending his money on, why his expenses are running high. But his expenses here actually look pretty decent. Just he's missing out on his revenues. So we need to try to figure out why that is. Again, is it weather related? Did it rain? He wasn't able to mow as much. If things can be explained away, then it's not a big deal, but we just want to make sure that that's the case. Okay, the next one talks about industry benchmarking. So the SBDC has access to what we call IBIS World, which is an industry report. So we can pull that report for any industry. Sometimes it's not as specific as we would like. They're fairly broad industry reports sometimes, depending on what kind of industry that you're in. And but this is something that we can do for all of our clients. And so we're just going to use Eve's Big Long Cafe here as kind of a an example. And the green is her lawn cafe's numbers, and the black is the restaurant industry benchmark. So I've pulled this IBIS report, and the black numbers are numbers off of this report. The green numbers are Eve's reports. So we can see here on the food and drink that Eve is spending over 50% on food and drink. And when we look at the industry report, it says for her typical industry that you should be just a little over 30%. So we need to figure out why her food percent is higher. Is it excessive waste? Does she have new workers that aren't trained how to do it, so they're wasteful, which, you know, could be okay if you have somebody new in there. They might not be as proficient as somebody that you've had for a couple years. Does she have an overly complex menu? And so that means, like, do you have things on your menu that have ingredients that you can't use in a lot of your other dishes? So is that one thing going to waste? Are your menu prices too low? How long has it been since you revamped your menu? How long has it been since you looked at, we all know that when you get a vendor that you're comfortable with, sometimes you don't take the time as an owner because you're wearing many hats to take the time to look and see that your vendor has just been slowly increasing your prices on. So that's something that we would want to look at. Are you having kitchen theft? Lots of restaurants put in place that their employees get one meal while they're working an 8-hour shift, or drink or something. So we just want to make sure that we can figure out why Eve is spending so much more on food and drink versus what the benchmark says. If we figure it out and we can increase, if we can figure it out, then the increase in profits can sometimes be fairly significant. Okay, so the last one, the last thing we're going to talk about here is the fraud and embezzlement protection. This is just another good reason to look at all three of these reports and try to understand kind of how they all work together. So the first thing here that we have circled on the balance sheet is the cash in bank. That's an easy, you can call up the bank to see what your bank balance is and then have your office admin run your balance sheet. That number should be close to the same. So it's a good idea to let whoever does your books, if you're doing your books kind of in office, to let that person know that to have them print off a balance sheet and a profit and loss for you every month, and for them to know, you to sit down with them and for them to understand that you're looking at those reports, that you understand what they mean, and that can sometimes be enough to get somebody to not try to embezzle from you. Again, the loan balance, the note payable, that's another quick call that you can get from the bank. And then the bank loans for the period and the loan payment to the bank. Again, I kind of showed you when we were walking through these statements how these things work together. So you can see that where these numbers, actually this shows it a little bit better here, that if you take the 1500 and the 2360, remember the 3680, and we took it from the 9910, that's the 6050. So the number on the profit and loss should match here from on your cash flow. Again, your sales should match, your profit and loss should match whatever sales show on your cash flow. So if there's discrepancies in these things, then that is a red flag to you that you need to start looking a little closer. If you have an accountant that does your books for you, I highly suggest that you sit down with them at least quarterly. Don't make the CPA a place where you go one time a year for taxes. Take the time, especially in a small business. I've seen in I cover an 11 county area here in Southeast Kansas, and unfortunately I've seen a couple times in the short 3 years that I've worked for the SBDC, somebody that had embezzled, and it ends up closing down the company because they just can't come back from it. So again, down here it says deterrent, let the bookkeeper know that you do this. Okay, so the last topic, how are these reports created? So accounting software is obviously the easiest way to be able to input your assets and your liabilities, your sales and your expenses, and to be able to quickly print out a profit and loss and a balance sheet and a cash flow. And there's many other reports that you can pull if you use accounting software. You can pull accounts receivable and see what that number is. It even breaks it down 30, 60, 90 days. You can pull an accounts payable report so you can see what you as a business owe out to vendors. And here I have that says that QuickBooks is the leader. They have 80% of the market share, maybe even more than that now. I am a QuickBooks Pro Advisor, which just means I've taken a little bit of testing. I am competent in online and desktop, although the way of the world is going online. Online makes it a little bit easier for me to help you if you are outside of Pittsburgh. And I do offer training in QuickBooks, and sorry, ignore this next QuickBooks workshop date. I should have changed that. I have been, since COVID, I have been helping people through Zoom, and I've helped one company during this time get set up on QuickBooks, and I use Zoom and a couple other tools so that I could see their computer screen, and I was able to get them set up and running. Now, obviously, ideally is that we would sit down together either in my office or at your place of business, and I would help you set up that system. But when we start doing training, we do offer a $25 coupon if you've attended any of our previous sessions. So when we can start offering in-person sessions again, we will email you that $25 coupon when we email you this webinar after the presentation. We will email you the webinar, and we will also ask you to take a survey. So we're at the end of, our presentation. And so my coworker Mindy has been monitoring our question and answers. If we have any questions or any chats. Anything out there, Mindy?
At the moment, I'm not seeing any questions.
Okay. Okay, well, you guys can see my contact information on here. You are more than welcome to email me. We are not working in the office yet, but I will be starting, I believe June 15 is the date that we have been given, and I will start working in the office on Monday and Tuesday. But throughout through Thursday, there will be somebody from the SBDC actually in Block 22. We're asking that you make appointments, but if you email me any questions that you have, or if you want to set up a Zoom session to go over your financial reports, we can definitely do that.
Okay, we do have one question.
Okay.
What if your balance sheet doesn't balance? If the revenue is correct and the owner's equity is correct?
Okay. Revenue should show up on, is he meaning cash is correct, I guess? I do not know. It should match. I would have to take a look at your balance sheet to see if we have something in the assets that are incorrect, because your liability, if you add your liabilities and your equity together, that should be the same number as your total assets. So if that is not balancing, then I would need to take a look at your reports to see if I can help you figure that out. It should always balance. Those numbers should always match. Any other questions?
I think that is all. Yeah.
Okay. So be looking for this webinar to come to you in an email with a survey. We will also send a services sheet so you can understand what other services that we offer. Please take time on the survey. It will take you less than a minute to fill out. If there's any other topics that you are interested in us presenting on, and that helps us kind of know what our clients are, what type of information that you're looking for. And again, if you want to sit down and look at your financial statements with us, just send me an email. My boss, Randy Robinson, has 20 years of consulting experience. So if I can't figure it out, more than likely he can. So yeah, thank you for taking time out of your day. And I hope you have a great rest of your day and that you got a couple of gold nuggets out of this. Thank you.